Good morning, ladies and gentlemen. We would like to thank you for attending this conference on our BL Equities Europe Fund. This fund is managed by Bouillot for more than 15 years now. It applies BLI's investment approach that focuses on the generation of attractive long-term risk-adjusted returns. The strategy is benchmark agnostic, conviction-based, and aims to invest in high-quality companies that benefit from solid competitive advantages and a strong capacity of free cash flow generation. 2020 has been a challenging year so far. In this context, on a year-to-date basis, as of end of September, the fund has a flat performance, while the MSCI Europe depreciated by more than 12%. On a longer-term horizon, the fund is ranked first quartile in its Lipper P group on 3, 5, and 10 years. Before starting, a few words on Banque de Luxembourg investments. BLI is the asset management company of Banque de Luxembourg. We manage around 13 billion euros, of which 31% are invested in pure equity strategies. Please feel free to ask questions using the chat system. We will try to answer them just after the presentation. A summary of the call will be published and sent to you in the coming days, both in English and in French. And now I leave the floor to Ivan, the fund manager of BL Equities Europe, who will give you an update on his strategy and the portfolio. Ivan?
Yes, thank you, Françoise. Good morning, everyone, and thank you for joining our update call on BL Equities Europe. As an introduction to the call, I'm pleased to share with you that our progress on the ESG front. As you know, we've been adding an ESG layer in our methodology for the last 3 years. We have now finalized the integration of our ESG policy deeper in our investment process by clearly defining impact objectives for the companies we invest in, for example, in terms of environmental footprint, in terms of working standards and working conditions, and also in terms of board independence. These measures go hand in hand with interactions and engagements with the companies, as well as votings at the AGMs. We are assisted by 2 dedicated ESG analysts to perform these tasks. We have also integrated an ESG risk factor within the calculation of our cost of capital. And currently, we are applying for a SRI label, starting with the France SRI label. So should you be interested in discussing further BL Equities Europe ESG policy and integration, our analysts and myself are available for dedicated calls. So before addressing the year-to-date performance and the strategy in the face of the current crisis, I will very briefly review the portfolio investment approach as a refresher and for purpose of clarity for first-time listeners. BL Equities Europe is a portfolio that has been managing for the last 15 years with a strict bottom-up strategy. I invest in 30 to 35 strong European businesses. I focus on buying them at an attractive through-the-cycle valuation, and I have a minimum of 3 years timeline for my investment thesis. A strong business model here is defined as a company whose business setup and differentiation versus competitors is the foundation of their development and should lead to attractive compound returns over time. Also, be aware that I do not trade much, as great stories can develop over many years, which translates into an average turnover ratio of 25% for the portfolio. Finally, the attention I pay on individual company valuation, but also on average portfolio valuation, give the portfolio a conservative growth profile, with the portfolio having been historically less volatile than the market. Important also to address that the strategy is backed by long-standing investment philosophy shared by all BLI fund managers. We consider each investment as a long-term equity investment in the capital of a company. As such, we strive to invest in companies that fall within our areas of expertise and look for transparent and clear business models, amongst other things, in terms of accounting and business setup. The main purpose here is to reduce investment risk and important or permanent capital losses. Regarding company selection, I look for companies with a sustainable competitive advantage that I consider critical for long-term value creation by the companies. Our process is rigorous in terms of the kind of competitive advantage we look for, as well as regarding financial and ESG metrics. Typically, we will have companies with a strong balance sheet, decent profitability, and access to profitable organic growth opportunities. At the portfolio level, the weighting of each investment results essentially from our conviction on the course of the company's business and the attractiveness of its valuation. As the portfolio is benchmark unaware, I have a great flexibility in terms of allocations. Let's move on now to the year-to-date market environment and the portfolio behavior. Well, the environment has obviously been quite nasty since February with the spread of the COVID-19 and its dramatic sanitary and social consequences. Financial damage has been important and economic visibility remains low, with the resurgence of the virus and the many sectors and companies considerably fragilized by the crisis, for which consequences I think still have to materialize. Monetary and government authorities around the world have stepped in to sustain the economy and the markets, but at a cost of higher debt, higher deficit, and increased liquidity in the system. These imbalances will need to be financed one day, but as for now, and with a better than feared economic recovery, markets have recovered part of the losses suffered in Q1. In respect to European markets, 2/3 of the downturn has been recovered as of now. In this environment, our focus on resilient sectors and companies with a strong business model and a quality balance sheet enables the portfolio to behave better than the markets. As can be seen on this chart, the index is represented by the dotted red line and Bell Equities Europe represented with a dark blue line. We suffered from the sell-off that started in February, but the portfolio resisted better than the market and managed to slightly increase its outperformance during the rebound. As mentioned by Françoise, at the end of September, the portfolio is flat year to date versus the index at -12%. As can be seen in the second column of the table, this return has been achieved with lower volatility than the market. And bear in mind that historically, the behavior of the portfolio during difficult times is an important alpha generator and contributor to the long-term return of the portfolio. Suffering less in the downturns enable us to need to recover low returns when the markets rebound. In terms of performance attribution, I apologize, we do not have the official performance attribution by our provider. We can send it to you upon request, so I have taken this data from Bloomberg. A big part of the outperformance, close to 9% of the outperformance, is due to sector exposure, and a little bit more than 3% is due to stock selection within these sectors. Obviously, the positive sector contributors are in the technology, industrials, and specialty chemicals, and we benefited by not being invested in financials, telecommunications, and energy. For first-time listeners, be aware that structurally, we do not invest in financials, telecommunications, and energy because they are lacking the qualities we look for companies or the transparency in their accounting. In terms of negative sector contributions, we can mention the healthcare with two negative performance holdings. Positive sector contributors, we can see essentially strong companies who are really in a good business cycle, like Sika, Kone, Christian Hansen, SAP, Reckitt Benckiser, or Dassault Systèmes. In terms of Sika, for example, benefited from an extremely strong, it's a chemical, specialty chemical company in the construction sector, and they benefited from an extremely strong execution and very close relationship with the customers during the crisis. Kone, one of the leading elevators company in the world, benefited from a much better business environment in China versus what was expected. SAP too is at the beginning of a long-term cycle and benefited from quite a resilient demand by its clients despite the negative economic environment. In terms of negative sector contributors, we see Danone, DCC, Grifols, Smith & Nephew, Kion, and Norma. Maybe important to highlight Grifols, for example, it's one of the leading providers and developers of plasma in the world, has been suffering from essentially over the last months a lower capacity to receive blood from donors because there were less visits to their centers, especially in the US. Smith & Nephew, obviously, it's a medtech company, has been suffered by a delay in elective procedures in hospitals due to the necessity of hospitals to take on COVID patients. And Norma, for example, which is exposed to the automotive industry, has been suffering since the beginning of the year already by a weaker demand in this sector. In terms of transactions and exposures, I've essentially sized 5 new opportunities during the month of March and sold a few holdings to fund these new opportunities. And overall, I have kept a balanced portfolio towards defensive, growth, and cyclical companies. I will not go into the details of the companies because these investments were initiated in March, and so we already addressed the investment cases during the Bright Talk conf call of the month of April. But although not immune to the economic downturn that we are witnessing, these companies, I think, have a strong business model that will enable them to weather the turbulences we're experiencing without losing their strength. So I included in the portfolio during the month of March SGS, which is the world leader in inspection and certification services. I included in the portfolio at a dividend yield of close to 4%. I also reinitiated, because I used to be a shareholder, a position in Dassault Systèmes, which is a pioneer and leader in software for product design and computer-aided design. This is a company that is structurally growing because more and more of the clients are using these computer-assisted design softwares. Geberit, the third new investment, which is a major player in the plumbing and bathroom technology sector across Europe. Despite being exposed to the construction industry, Geberit, through an extremely well decentralized business model, is able to profit from very well identified local opportunities, each one different according to the markets, geographical markets in which they operate. Fourth holding was L'Oréal, a leading global player in cosmetics, and Christian Hansen, finally, a producer of natural enzymes, which are consumed daily by hundreds of millions of consumers, for example, through dairy and cheese products. At the same time, I've been strengthening a few holdings, essentially a big holding in the portfolio. SET, Roche, Avast, which is a leading security software provider, Adidas in the downturn, Pernod Ricard, and Fresenius. Fresenius is a German company who is suffering quite a lot from one of the 3 divisions, private hospital divisions. As Smith & Nephew was impacted by the crisis, Fresenius too, they had to postpone all the elective procedures to take on COVID patients. And of course, the visibility on the reimbursement of the cost engaged to take on these patients is still very much uncertain. This is why Fresenius rebounded a little bit, but is still trading at a significant discount to its intrinsic value. This new investment has been financed by the sale of a few positions in the portfolio and some of the cash we had available. All in all, 7 companies were sold this year, 3 in March, 1 in April, 2 in May, and 1 in September. Essentially, the 3 companies sold in March, Kion, Norma, and DCC, was sold because of the lack of visibility of the pickup in demand due to the current economic environment. The sale of Danone in the end was due to my desire to limit the number of positions in the portfolio, but also because Danone was not providing the defensive profile I expected from it. Beiersdorf was sold also during the month of May to focus on L'Oréal. These are competing companies in certain markets, and I would say that I'm extremely pleased by L'Oréal execution on the digital strategy and building a real digital platform, a global digital platform, which has been and will continue to be extremely important as an earnings contributor for the company. And finally, I sold also Henkel in May due to the continuous relative weaker performance of the consumer business unit when compared to their peers in the market. And I don't see a quick turnaround for Henkel in the consumer business unit. And finally, I've been selling Smith & Nephew because of a lack of visibility of return on capital improvements with the problems hospitals are facing, and maybe the real need for strong innovations currently to have a higher pricing power with hospitals. Sorry, there's kind of maybe a slide is missing here, but let me move forward because I think a slide okay. In terms of exposure within the portfolio, we see that we have a kind of similar market capitalization exposure compared to the index. Usually, we've had more higher exposure than the index towards market capitalization below 50 billion euros, but this has been not the case for the last 3 to 4 months because of the selling of some small and mid caps. In terms of sector exposure, we see quite a big exposure in the traditional industries in which we invest. Since the beginning of the year, essentially the exposure towards consumer staples has been reduced, and the exposure towards technology and industrials has been increased since the beginning of the year. In terms of countries, we also see here bigger concentrations towards countries where we find a lot of the European expertise in industrial, consumer, healthcare, and technology industries like the UK, France, Germany, Switzerland, and Sweden. So here we see the main holdings of the portfolio. We currently have 32 holdings in the portfolio. The top 10 represents almost 50% of the assets under management. For those who are following the portfolio for a long time, you see that quite a few of these names have not changed, but we are still very much convinced on the investment thesis and the attractiveness of the valuation, with maybe 1 or 2 exceptions. As mentioned during the performance attribution slide, I still have a very strong conviction on Sika and SAP, which are the 2 main holdings in the portfolio. They are both in a very strong business cycle with a sustained capacity to generate high levels of free cash flow and to continue to grow even in these difficult times. Sika, for example, again had a very promising capital market day 2 weeks ago, which really highlights in very much details how it performed during the crisis and the strategy going forward to continue to capture market share and outgrow its competitors despite being in a cyclical industry. We have then 2 more defensive companies, Unilever, everybody knows, and SCT, which is a leader in incontinence products, professional hygiene, and consumer tissue, which provides a more stable basis to the portfolio. SCT it is an attractive investment for the next 2 to 3 years, I think, because the company is in the middle of a process to reorganize its operations and its product portfolio with the ambition to increase its profitability and its potential growth rate. Roche seems to me to provide an attractive valuation and dividend in combination with attractiveness of its portfolio rejuvenation, which I think is not yet priced in the market valuation. And maybe finally, Air Liquide, the French industrial gas company, which is benefiting from recurring revenue profile, and also its continuous investments in the development of hydrogen as a substitute to fossil derivatives, and which we have seen in the press recently, hydrogen, which certainly be pushed forward by authorities as a new substitute to fossil derivatives. We see here some metrics of the portfolio. Around 60% of the portfolio is invested in what we call consistent earners, where we find essentially more defensive companies like a Unilever or a Roche or a Air Liquide, but also cyclical companies like, for example, Rotork, one of the world leaders in the valve industry in the UK. And a third of the portfolio is invested in what we call growing franchises. So these are smaller companies, growing companies, where the bigger holdings, for example, is Sika. So these companies are more structurally growing companies than what we find in consistent earner category. And the established value category, we just have one holding, which is SCT, where we expect an improvement in profitability, as mentioned before. We see on the right part of the chart some financial metrics of the portfolio. We can't escape the fact that quality indeed is expensive, is more expensive than the market today. So we have a PE 2021 of 25% versus the market at 16%. But of course, this high valuation metric is the result of higher quality profile of the companies in which we invest, and also the fact that these long duration assets benefit from lower interest rates in the market. We see, for example, in terms of quality, a return of equity of 21% and a net debt to EBITDA ratio of 1.7 versus 3.6 for the European market, represented by the Stoxx 600. In terms of earnings growth profile, according to Bloomberg, the weighted average earnings decline expected for this year for the portfolio is around 7%, with an expected rebound of 24% for next year. Of course, this is just a punctual figure, which is still very difficult today to assess whether we will have such a big magnitude in the improvement of the earnings of the portfolio. To conclude the data about the portfolio, we will now more intensely communicate also on the ESG metrics of the portfolio. Overall, we see that the portfolio has a slight better profile than the MSCI Europe in terms of ESG ratings, should it be on the average score, but also in the individual metrics, which are environmental, social, and governance. We illustrate the one we focus on, carbon emission intensity, climate change initiatives, the human capital theme score, and also when we look at the labor management controversies that might appear in some companies. In terms of governance, we also see a better average score, and we focus a lot in board independence for this metric. So in terms of conclusions, I would say that I don't think we are yet out of the woods regarding the COVID crisis. And as such, we have limited assurance on economic and financial metrics going forward. I also don't think we've yet seen all the social and financial consequences of the crisis. Usual social habits will still be jeopardized as long as we don't understand better the virus or have a vaccine. Nevertheless, this situation I think could go both ways, either over the next year, either better or worse. At the present time, what we can see is that we are witnessing better than expected economic recovery, but of course these data are from the months from May to August, before the second wave kicked in after the summer months. Global equity markets have recorded, despite this environment, the strongest rise for the last 20 years. Divergences in the market performance stresses that certain sectors and industries are significantly weakened by the crisis, the retail, for example, and as such, this warrants a lot of selectivity at the time of investing. And also importantly, I think the rise in equity markets have accelerated prevailing trends. The important liquidities available through aggressive monetary policies, and the fact that real interest rates will most certainly remain low for the foreseeable future, has benefited the so-called quality and growth segments of the market, pushing valuation metrics higher. And although I completely understand it's normal that long duration assets offering visibility and growth warrants a premium given low rates, in our process attention is warranted should inflation rise or economic activity continue to pick up, which would benefit the value segment. So all in all, from my and BLI perspective, the qualities that we look for in companies we buy are ultimately quite independent of the economic environment. First and foremost, these qualities include a sustainable competitive advantage, low capital intensity, and a strong balance sheet. And if inflation remains low, the high level of free cash flow they generate will enable them to benefit from a low interest rate environment. And if inflation rises, I think the competitive advantage we look for will allow companies to raise the prices, and the low capital intensity will enable these companies to have a restrained maintenance capex. So all in all, both at decent valuations, I think that these companies should continue to provide attractive rates of return over time, despite potential counter-performance when we have value coming back inflation in the markets. I will as such continue to maintain conservative bias in my portfolio in order not to have a too high average valuation exposure. So this concludes my update for today. Please, should you have any questions, don't hesitate to send it through the platform, or otherwise we would be available to have a dedicated call to answer your specific questions later on.
Thank you, Ivan. From now, we do not have any questions. While we wait a few minutes to check if questions are coming, I just want to thank you, Ivan, for the update and for the time you took to explain your strategy and the portfolio. I would like to thank you all for attending this call. Do not hesitate if you have any questions coming later on to contact your sales representative. He will be able to forward the questions to Ivan, and we will be happy to answer to them. Well, I do not see any questions, so I think we can close the call now. Thanks again for participating. We will send you the summary when it will be ready, probably in the coming days. Thank you, Ivan. Thank you all. I wish you a nice week and be safe. Bye.
Thank you. Goodbye.